Yeah, thanks a lot, you guys, for coming out this morning. So we're gonna go through all of our conventional loans, our FHA loans. We're gonna also discuss VA loans, kind of the ins and outs of them, and the pitfalls, the advantages, and kind of what to look out for when when we have clients looking at these different types of loans, right? So first and foremost, what you guys need to know is that there are loan limits, right? So if someone's going to be taking out a loan, after a certain amount of money that they're borrowing, it becomes a jumbo loan, right? And we fall into the jumbo category here in San Diego all the time, right? And jumbo loans are just touching on them are a lot more restrictive. They look at reserves a lot more critically. They calculate income differently, especially for self-employed borrowers. Everything is handled a little bit uniquely depending on the actual investor. And so you also have they're a lot more critical with appraisals, with documentation that they require. They're harder loans to qualify for.
Debt
The
to income for
the debt
sure.
to income levels took the words out of my mouth. They're lower. So you can't go up to like 50% like you can for a conventional loan, 55 for FHA loan, 65 for a VA loan. That doesn't happen. The majority of the time they cap out about 43, sometimes 45% debt to income, and we'll dive into all that as well as we're going through all this stuff. So conforming loan limits in San Diego for 2024, $766,550, right? That was what the conforming, that's the least restrictive of the two. When you start jumping into anything over 766,550, all the way up to $1,006,200, sorry, that should be $200. Now you're talking about high balance loans. And high balance loans are a little bit kind of a blend between your jumbos and your conventionals. They get a little bit more restrictive from a debt to income standpoint. They're going to sometimes look at reserves. They're going to they're just a little bit harder to qualify for, and they become more expensive. And by more expensive, I mean there's typically points involved with the rates. The rates are a little bit higher than your traditional conforming loans, and it's just like I said, a little bit harder to qualify for. Not a lot, but a little. Um, and again, once you get over that 1,006,200 level, you are now talking about jumbo loans. Now, keep in mind, that's for a one unit, right? If you have multiple units, those numbers change. Okay. So if you have a two unit, you can still get a conforming loan all the way up to almost $1.3 million. If you have a duplex, still a conforming loan. A four unit, almost $2 million. You could still get a conforming loan. So again, because if you jump into a jumbo and you're looking at a four unit, some investors don't want them. Some investors will only touch single unit, SFRs, condos, townhouses. They won't touch multi units. Some will, but they become much more expensive. There are adjustments to the interest rates once you fall into the multi unit arena. All right. So you guys, you're going to be taking your listings, and please stop me. If anybody has any questions, just interrupt. Just say, hey, Ed, real quick. So you're going to be taking listings, okay? You're going to be walking houses with people. So three things to look out for that are critical in purchasing a home. All right. You have to have smoke detectors in that house. They have to be on every floor and they have to be outside of every bedroom. All right. You have to have carbon monoxide detectors, pretty much the same location. What I would do is I would make sure that your if you don't see one, just get the combo one at Home Depot. Like I know most realtors have like a half a dozen of these sitting in their trunk, right? Just because if you need one for whatever reason, just go in there and screw it right on. Boom, pop a battery in, you're good to go. Smoke detectors, carbon monoxide detectors, get the jumbo ones, and then the most important part is those hot water heaters need to be double strapped because of earthquakes. I will send you over all of this in an email. Not a problem. Easy day. Um, FICO requirements, you guys. So those three components, just when you're walking around, just keep an eye out on them. All right. Um, let's see. Conventional loans, right? Traditionally, conventional loans are good for people with good credit. Okay. People that have saved some money for a down payment. And you know, they have people that haven't had too many like credit issues in the past. All right. So FICO requirements, you have to have a 620, right? There are some programs out there, conventional programs as well as FHA programs, that if you don't have these types of down payments, they allow for down payment assistance programs, right? There's CalHFA, right? That's a California Housing Finance Authority. There's Golden State Finance Authority, GSFA. There's a San Diego Housing Commission, which includes all of San Diego City. So anything that starts with 921, anything San Diego County. It also has Chula Vista in there. So they have great programs, but again, very when you start getting into those down payment assistance programs, keep in mind that a lot of them have very strict criteria to how to qualify for them, especially when you're talking about dollar amounts, right? So your not only your loan values, right, your loan amounts, but also your debt to income levels. They look at how much assets, like the San Diego Housing Commission. You can't have more than $10,000 of assets left after the transaction in order to be able to qualify for their down payment assistance programs. So each one is very unique, and I'll do a whole class on down payment assistance programs, but I wanted to bring it up because they do exist and they do help a lot of people in San Diego, so and Chula Vista and all over the county. So if there's anyone that you bump into who's like, oh, you know, I have decent credit and you know I have a good job, but I haven't really saved up a whole heck of a lot of money for down payment, you can easily still get them a loan. All right, not a problem. We just need to be able to review all of them. Let's see. So 3%, you guys, for a conventional loan, minimum down payment. Straightforward. And in all honesty, down payment assistance programs are great. But at the same token, like you should really have 3% saved up if you're going to be buying a house. Like, what are you going to do when you move in if you don't have that 3%? Like, think about it. You buy a $700,000 house, it's 21,000 bucks you haven't saved up, plus some closing costs, maybe another 10, 15. Like, if you don't have that money, you're probably not ready, right? You might be ready for those monthly payments, but you probably aren't, right? At the end of the day. So it's kind of one of those things where we have to evaluate, like we have to take a look at their credit. We have to evaluate each individual client and make sure that they're in a good financial position to be making this transaction, especially if they haven't saved that 3%. 5% once you get into the high balance. Again, remember I told you it's a little bit of a different criteria between the conforming, which is the 3%, 5% for the high balance. Anything over that 666, 550, that's what we're talking about. When you get into the jumbos, there are some 5% jumbos, but majority of them are 10%, you guys. You really want to be in the 20% level when you get into the jumbo because your interest rates are going to be astronomical if you're trying to get the 10%. Occasionally, you will find a lender out there willing to do 5 on a jumbo, but I would not want to see the rates because what they do is look at the end of the day, right? And I'll jump into mortgage insurance a little bit here. So if you don't put 20% down on a conventional loan, you have what's called mortgage insurance. So basically the lender is saying, hey, you don't have enough skin in the game, okay, for me to be able to trust you to pay this loan over X amount of time. Not only are you going to pay insurance to protect me every month, but you're also going to be paying your tax and insurance on a monthly basis. We're not going to let this roll where you have the option, right, when you put 20% down to pay for your own taxes and your own insurance separately. So all you have to do for a monthly mortgage payment is pay principal and interest, right? I do that. I'm good at saving. I'm good at squirreling money away. Twice a year, I pay my taxes. Once a year, I pay my insurance. Good to go, right? But when you don't put the 20% down, they won't allow you to do that. So at the end of the day, when you have a 5% down loan, you're paying principal, interest, taxes, insurance. It's called a pity payment. You're going to hear that used in our industry a lot. Pity payment. Principal, interest, tax, and insurance. You're also going to pay the mortgage insurance, right? You can get away with the 5%. If you're buying multi-units, there's going to be different criteria for how much down. And that's if you're living in them, right? So those are owner occupied. If you're going to be buying it as a second home, you have different criterias, right? So 10% down is going to be the minimum. If you're going to be buying a multi-unit as an investment, again, totally different criterias. You have 15% down as an investment for a single unit and 25% minimal down for a multi-unit, anything 2 units or above. I've had some knucklehead loan officers out there tell me, "Oh, I'm putting 5% down on an investment property." I'm like, dude, get out of here. Like, you don't know what you're talking about. Honestly, it is really important to know these things, because if you're speaking to a client and they're telling you that, hey, I want to do that house hack that everyone's talking about, and live in one of the units, rent everything else out. If it's a multi-unit, a real multi-unit, and it's registered or registered as a multi-unit online, right? You have to put these down payments down. If it is registered as a single family with an ADU, it's different. So you have to look at what the coding is when you pull up that title profile and understand what you're reading, right? And I can bring in a title guy and kind of go over all that stuff with you guys. But it's really important to understand that as well. Questions, you guys? I know I'm kind of whipping through all this stuff. No? All right, cool. I'm gonna keep going. So conventional loans, they have a little bit of a different waiting period than you have with FHA and VA loans if you have some sort of major credit event. And by major credit event, I mean if you short sold a property, if you file for BK, if you had a foreclosure, what have you. Conventional loans are the most restrictive ones out there. And then FHA is really was built back in 1938 is when FHA came out. And the reason why, and it doesn't stand for first time home buyers, you guys, it's a federal housing authority. Um, and the reason why it came out, because back then there were so many people that got devastated by the Great Depression that they wound up having horrible credit scores. Yes, they had credit scores back then, in a way. And when bankers were evaluating their credit, they wouldn't lend them money. And so the government stepped in and said, "Hey, we're gonna lower our criteria from what the conventional programs are. We're gonna come out with an insured product, right? An insured loan, and we're gonna subsidize these loans. And that way, people with poor credit or slightly dinged up credit from whatever happened in the past may not necessarily be a short sale, may just be a bunch of lates, right? And they're in the 600s rather than in the 7 or 800s. Those people have somewhere to go. They have an outlet to be able to get money to be able to purchase a home, right? So the government stepped in and created the Federal Housing Authority, the FHA, and that's where it kind of jumped in. So again, you guys can read about this: 4 years for a short sale, 7 years for a foreclosure. Depending on what type of bankruptcy you have, will determine how long you have to wait in order to be able to get a conventional loan again. Make sense? Cool, no questions. Awesome. So let's see, mortgage insurance, kind of touched on that, right? So mortgage insurance is really difficult. You can't just like throw out an arbitrary number on conventional mortgage insurance. There's like 20 something different variables that go into determining, just like an interest rate, mortgage insurance is determined the same exact way. They look at how many borrowers are going on a loan. Are you a first time home buyer? They look at your debt to income. They look at your credit scores. They look at what type of house are you buying? What's the house for? Where is it located? So like all these different criterias, right? And you wind up plugging everything into a big form, and you click it and it shops around. We shop, I think, about a half a dozen different mortgage insurance companies, and we choose a lesser of the evils because look at, they're all the same at the end of the day. That mortgage insurance is going to protect the lender in case of default. Right. So again, they don't think that you have enough skin in the game up until that 20% mark. So they make you buy mortgage insurance. Now you can buy it, or you can pay for it a couple of different ways. You can have the borrower pay for it on a monthly basis. The borrower can pay for it in a lump sum, which really comes in handy if we do have an appraisal shortage. I kind of combine that with a different strategy that I call an appraisal gap insurance, and we shift some cookies around if people are putting money down, and we're able to still have that 20% down payment and purchase a little bit of mortgage insurance and kind of finagle the numbers a little bit. So there's a very little difference with the monthly payments. If your appraisal is short, let me know, and I can help out your borrowers really minimize the amount of money that they're coming out of pocket. They don't have to come up with the entire gap. It's literally usually just a few $1,000s. The last one I did, back when appraisals were coming in short, were it was like a $40,000 gap. I think it cost them like an extra 2,500, $3,000 out of pocket, to buy mortgage insurance to make up for that gap, and we called it a day. Mortgage insurance, again, it's complicated to figure out that mortgage insurance. We plug it into a formula and it comes out. Now, you can remove that mortgage insurance once you hit a certain criteria. Typically, they require you to keep that mortgage insurance for at least 2 years, sometimes from 2 to 5 years. If your property has gotten to the 25% equity line, then a client can take an appraisal and go to the bank, go to their servicer, right? And say, hey, here's my appraisal. I've done all this work on this house. The house value has appreciated over the past few years. I'd like to remove my mortgage insurance. And they'll take it off. You just need to provide them with documentation, right? So I just saved a client $100. He was really struggling. I was just calling my clients that I call once a year just to check in. And he said his wife was really sick. She was in a hospital. And I said, I'm looking at your overall scenario. It looks like you're still paying mortgage insurance. Why don't we see if we can take that off? He bought back in 21. He had 25%, greater than 25% equity. I linked him up with my appraisal friend Sydney, who was awesome. Went out there, did an appraisal. We submitted it to the servicer, and he's saving himself $100 a month. I mean, it's not a whole hell of a lot of money, but at the end of the day, like, his medical expenses for his wife are through the roof. So every single penny counts. And it's really one of those things where, it's you got to stay on top of all your clients, current and past clientele, and really check in with them at least once a year just to say hi, see how they're doing. And you never know when something like this can pop up, and you can really help somebody make a difference in their life, even with $100. So again, 25% from years 2 to 5, 22% after year 5. Okay. Once you hit that 22%, again, all you need to do is provide them with that appraisal and they'll remove it. Okay. After 5 years. And then it doesn't necessarily automatically drop off. You kind of have to give them a heads up and ask for it, because it's not necessarily in their best interest to remove that mortgage insurance. So they're not going to just take it off. You got to get in touch with them. Condos, you guys. Condos are a little bit different. We did a whole condo class at the beginning of this semester, right? So hopefully if you guys missed that condo class, it is already on YouTube. You can feel free to go to just YouTube Ed Belinky, and it's at the very beginning, and we dive into like the real nitty gritty of condos to make sure, and we talk about all the guidelines that need to have happen in order to get them approved. But right now, the big thing is deferred maintenance. A lot of these condo complexes have had deferred maintenance, and they signed a new law in about a year ago after that tragedy in Miami, Florida, where we had that huge condo complex fall and so many people lost their lives. Fannie Mae revamped their condo policies and said, hey, we want everybody to have some sort of inspection within the past 3 years for your any kind of stairways, any kind of balconies, right? And so a lot of these condo complexes have just deferred maintenances for a long time. And when they did wind up doing these inspections, all of a sudden they get these huge bills, sometimes hundreds of thousands of dollars. And how do you pay for it, right? I'm on the board of my HOA. You have to raise HOA dues. That's the only way to do it. Either do it on a monthly basis or do it in a lump sum as a supplemental. You gotta hit everybody for them. So, which really sucks. Like, nobody wants to do that, right? But unfortunately, we're required to, because how else are you going to pay for all these repairs? And so there is a project like right here in Mission Valley. I know a few people have had listings over there. Got a friend tried to sell her place over there, and they got hit with $6,000 a unit. And a lot of people can't afford just shelling out $6,000. And until that is paid for and fixed, you can't do a conventional loan in that project. Sometimes you can get away with a VA loan. You can definitely do all cash. but you might not necessarily be able to do a conventional loan. So it's really important. If you guys have any condo complexes out there, or your clients are thinking about putting in an offer on a condo complex, um, get in touch with me and Matt. Just send us the address and be like, "Hey, Eddie, can you order the condo docs on this project? We just did one on Friday." And that way we will pay for those condo documents. Our condo team is spectacular. They will go out there, they'll order the condo documents, they'll review everything, and they'll tell you which loans can be done in that particular complex. So please don't hesitate to use this as a resource. If you have anybody putting in an offer, or you have anyone who you're going to be taking a listing, we can get that done in advance. And Matt actually has been like the guru of getting condos VA approved. He's done 3 of them this year alone. And what it takes, what, maybe 2 weeks, Matt? I mean, you've been flying
Got
through.
one. We just got one done in warp speed for actually Kevin
Yeah,
on the
for
office
Kevin King.
list. So yeah, it's a good tool to have. It's a good resource to have. It's good, it's good for everybody. We're just opening up the market for our VA borrowers. So
And it's a
the market.
great value add. You guys are going on a listing appointment on to somebody that owns a condo. Hey, we can help you out in opening the pool of buyers by possibly getting this FHA and VA approved if it's not already, right? If you're going to be taking the listing, just get in touch with us and we'll tell you what you can do in that project, right? Um, so again, condos they do have some restrictions. You can't have like one person own half of the place. Because what happens if that person dies? Who's going to be paying the HOA dues, right? So they do have restrictions on how much ownership. Now, mind you, there is one huge misconception, right? Where people are like, oh, well, if 51% isn't owner occupied, then you can't buy an owner occupied property there. That's absolutely false, you guys. Like, unfortunately, it's a misunderstanding of the rules. Now, mind you, some big banks like the Bank of Americas, the Wells Fargos, the Chases, they're super uber conservative when they have condominium complexes that they're doing loans on. Again, reverting back to if the market does turn down and prices do go down, right? The first things to the first things to foreclose and short sale are condos, right? Because they're the least expensive product out there, the most affordable, right? Um, so if you have someone that's going out there and they're buying an owner occupied property, Fannie Mae loves that. They want more owners to own in these condo complexes. So it doesn't matter what the owner occupancy rate is for an owner occupied property. It only matters if you're buying another investment property, right? Only they don't want the whole place to be investment property. So they will put a restriction on there that it can't be more than 51% um, or investment owned, right? So it has to be at least 50% owner occupied in order to buy an investment property there. Okay. Um, and then there are some other little there are some other little guidelines on there, but again, we kind of go over all this in the condo class with reserves and insurances and so forth. So feel free to watch that class to kind of get into the nitty gritty of it because it's not really as relevant here. Questions, you guys? That's kind of conventional loans in a nutshell, right? They're good for people who have good jobs, have good credit, over 700, okay? And for people that have money saved up, right? You're like your A buyers. You start getting into the B buyers, they can usually qualify for conventional loans too. They may need a little bit of help. They may need a gift or something like that from a family member, and maybe need some down payment assistance, what have you. We might need to work on their credit a little bit, but they're still there, right? They're still there. They still have a good job. Their debt to income, they can afford it, right? And let's just, since I mentioned it, let's talk about debt to income for a second. When you're going to get approved for a loan, we're just going to take a little side road here. When you're going to get approved for a loan, there's 3 things that an underwriter looks for to approve you for that loan, right? Does anybody know what the 3 C's are besides Matt? Don't all speak at once.
Come on, you guys should
Like
know it.
credit, cash, and something.
Cash is close, collateral,
Collateral.
collateral, yeah. And the third C is capacity, right? So credit, capacity, and collateral. Credit's easy, right? You fill out the application just like any other credit application, hit a couple of buttons, boom, I run your credit. The most important part isn't just your credit score, but it's your monthly debt obligations. And why is that the most important? Because that's going to drive the capacity to pay back that loan. And believe it or not, banks only started looking at capacity after 2009. Before that, you can like fog up a mirror and get $500,000, no problem, right? Like as long as you had a pulse and you were breathing, the banks would lend you money. It was crazy. And that's what drove the entire Great Recession or whatever you want to call it that happened in 2007, 2008, right? When the markets crashed and housing prices went down by half, it's because you had all these unscrupulous lenders coming out with all these shisty little loans where like they'll offer you 1.99 for the first 12 months and then it triggers up to like 6%, right? And yeah, sure. And you qualify on the 199, but you can't qualify on the 6% because your payment just doubled. So what happened? Everybody, like all these people, just start walking away from their properties. I can't afford it anymore. I'm not going to make the payments, and then the banks repossess them. And it was just a vicious downward spiral after that happened, right? So capacity is very important. We have your monthly debts. One of my most important jobs is to understand how to calculate your income, because that debt to income level, that ratio that I was talking to you about, can't be over 50%, right? If I screw up on that income, I'm screwing up that ratio, and I'm screwing up the entire pre-approval, right? Knock on wood, we don't have that issue. We get all of our loans underwritten if need be, right? But I've been doing this a decade, so I'm pretty darn good at figuring out income. But if I need a second set of eyes, I've got Matt, and then I've got my underwriters are going to review it, right? And so that's one of the most important parts, that capacity to pay back the loan. With conventional loans, 50% max. But a lot of times, you guys, if you have like a sub 700 credit score, it's going to reduce that debt to income level. I've seen it go down to 47, 45, 43. Sometimes we can't even get it approved at 40, right? And that's only because the guidelines are getting more and more strict as money is becoming tighter and tighter. Okay. So you have your credit, your capacity, and your collateral is the cash, right? Charlie, you hit it right on the money, right? It's where's the money coming from for the down payment and for the closing costs, right? You guys, it can't come from underneath the mattress. You can't be depositing cash like at the very last second to go make your EMD deposit, right? You have to have money in a bank account, and it has to have been in there, and it can't just show up out of nowhere. Like your mom and I can't just deposit. Well, they can't. They shouldn't deposit it into your bank account. If you're going to be getting a gift, they should be depositing into escrow once you get into escrow, because otherwise we may have to source where that money came from, right? So we want to avoid any kind of further documentation because they may have gotten the money from, they might have deposited into cash into their account. We don't want to see that, right? But what we do want to see is, hey, where did that money come from? And we need 2 months of those bank statements up front to be able to determine that that cash is eligible to be used for the transaction. Cool? That makes sense? So that's your 3 C's, you guys. Credit, collateral, capacity to pay back the loan. Super important. You have to know those. Because when you're speaking to somebody, they may have a great job and they may have the money for the down payment, but their credit might suck. Or their credit might be awesome and they have the down payment, but they work at McDonald's. You're probably not going to buy a house in San Diego if you work at McDonald's. I hate to break it to you. They might have an awesome job and they might have great credit, but they might not have money, but we might be able to fix that, right? With a down payment program. So again, every loan's like a fingerprint. They all have their own challenges, and that's why we're going to go through them. And if worst comes to worst, oh, Charlie, I didn't see you had a question. You mean we can't get a ninja loan anymore? No more ninja loans, brother. Doesn't happen. Nope. You can get a bank statement loan. Stated income, no mas. But bank statement loans, there's also what's called a DSCR loan, right? So that's a really cool loan for investors. And what that stands for is debt service coverage ratio, right? I always have to go over it in my head. I don't know why. And so basically what it means is, yes, you can get a bank statement loan, Deb. Basically a debt service coverage ratio is, it's going to look at how much money is the investment property producing on a monthly basis, and does that cover the mortgage? And if it does, 1-to-1 or greater, you get the loan. You just need halfway decent credit, right? That's it. It's really, they don't look at your personal income. And yes, we will go over all that in these are all non-qualified mortgages, bank statement loans and DSCR loans. And sorry, I'm going off on another tangent, but we'll cover all that in a different class. I just wanted to kind of bring it up and mention it to you guys because they do exist. They are out there. So kind of in a way ninja loans, but not really. So FHA loans, you guys, say you didn't have that credit. We're going FHA. Say you didn't have that 20%. We're evaluating FHA. We might not go FHA because if your credit's marginal, and you had a little bit of money to put down, you're still gonna have mortgage insurance. So we're just gonna compare the mortgage insurance rates, right? And we're gonna compare the interest rates. And we have a software, it's called Mortgage Coach, that we go through each one of these scenarios. We can put 4 different loan scenarios on there, and we'll figure out which is the least expensive way of financing this property. That's the one we're going to choose. And it doesn't matter to us. I want to save you as much money as possible buying a house. I don't want you to have to overpay. It doesn't make any sense. I'm not going to benefit at all from it. And you're probably going to be mad at me if I don't do my job thoroughly, right? I'm not just going to throw any loan that you ask me out there and say, hey, you asked me for an FHA loan, but you should be in a conventional loan. There's really no reason to be like going and jumping into an FHA loan. Why did anyone tell you about an FHA loan? You've got great credit. You got a great, you just have a little bit less money now. Like there's no reason to do that. So we have to look at everybody just like a fingerprint, man. They're all individual. All right. So the good thing about FHA loans, lower credit scores, right? They can go all the way down to a 580. If you do get down to a 580, now you have to have compensating factors in order to qualify for that loan, right? So you have to have decent, you have to have some money saved up. You got to be putting your own money down. You can't be going and getting a down payment assistance and have poor credit. It doesn't mesh like that. You actually have higher credit score requirements if you have down payment assistance programs. Usually they're anywhere from 660 to 680 is your minimum credit score. But 580 for an FHA loan. You have to have some time on your job, consistent work. You can't be like bouncing around from job to job. It doesn't work like that. You have to have a good work history. So you need some sort of compensating factors in order to, if you have a lower credit score. Minimum down payment, 3.5%. Really, again, not a whole heck of a lot of money, but there are programs out there that will give you that 3.5%. And they'll also, with a second loan, like you're going to have to repay that loan at some point. It's not like free money, but you can find a grant possibly for your closing costs that you can kind of piggyback on top of that first mortgage for 96.5% of the house. Think about it. What other asset out there can you purchase with 96.5% of other people's money? You can't, there isn't. That's it. Properties. I mean, and it's such a safe bet that a bank is willing to lend you that much money to purchase that home. I mean, there's really no other better investment out there, to be honest with you, than to owning your own home. And I have a finance degree and I've been in investments for 25 years and actually longer. Oh God, it's been like 28 years. I will tell you that housing is the way to go if you want to build true wealth in this country. 3.5% down, you guys, all the way up to $1,006,200. Let that sink in for a second. You can get $1 million if you just have 30 grand, 35, 36 grand. I mean, that's incredible. It's awesome to be able to have this kind of opportunity. They don't have that in other countries. It's us here. Now an FHA loan, similar to a VA loan, has to be owner occupied. It is a government loan, you guys. Remember, I explained that. The Federal Housing Authority came out to help people buy homes to live in, not as investments. Okay. However, you can buy a multi-unit. I bought my first 4-family when I was 24 years old, and I lived in one of the units. We put 3.5% down, and we rented the other 3 units out. Now, mind you, there's a really wonky rule with FHA. If you're buying a 3 or 4 unit, It's called a net net sustainability or net tangible sustainability rule. Anyways, there's a rule that says that the other 3 units, not the ones that you're living in, but the other 3 units of rent need to cover that mortgage. And if they don't, you can't take out an FHA loan to buy that house. Okay. So you have all these house hacks out there, buy a 3 unit, live in one of them. Well, the other 2 units need to cover that mortgage. And that's not going to happen in San Diego anywhere if you're putting 3.5% down. Shoot, I did a 1031 exchange of my condo, 300 grand trying to roll into it. I couldn't find a single place, one place in San Diego. I was searching for 3 months, one place that could actually come close to doing something like that. And that was with $300,000 down, not 3.5%. So you guys, multifamilies with FHAs outside of San Diego, yes. Here, not so much. But you can do it. Again, like I said, you have because these loans are meant for people that are credit challenged, they are shorter waiting periods. So remember, like you had 4 years for a short sale with a conventional loan, you got 3 here. With an FHA. Same with BKs, you had 4 over there, you got 2 here. Foreclosures was 7, it's only 3 with an FHA. So you do have that little bit of flexibility when you have credit events in your life in order to still purchase a home. So a lot of times we'll see someone, even if they had a foreclosure, we'll use an FHA loan to get them into a home after 3 years, and then they can refinance after 7 from that original credit event. And you have to reestablish your credit. You can't just like have a credit event and like just not get new credit, right? You have to like show that you're actually trying to build credit again, because you're not going to get a loan anywhere if you don't. All right. Mortgage insurance, a lot more straightforward with FHA than it is with conventional, which is a lot more credit based. This year, 1.75% upfront. What does that mean? That means that if you're borrowing however much money, $500,000, $1 million, I need to tack on 1.75% of that loan amount onto the loan amount. As you can finance it, right? Or you could prepay it too, but you have to pay for that upfront mortgage insurance. And basically what that does is that all that money goes into a huge pool and a massive bank account, right, with the United States government. And it sits there and it collects interest. And if anybody winds up defaulting on one of these loans, it goes and it covers the lender's rear end. Okay. And it pays for that difference in the short sale or in the foreclosure of that property. Right. And so that's why you have the government subsidizing these loans, right? So you can get lower credit scores, you can have lower waiting periods, you can have lower down payment amounts. Well, conventional loan, you can actually go 3%, but your monthly mortgage insurance is also a lot less. So if you're putting 3.5%, it's 0.55% of whatever you're paying. So that's for the whole year divided by 12. And then if you're putting 5% or more, it's going to be 0.5%. So the problem is that it stays for the life of the loan. It doesn't go away. Like conventional loans will go away. This is going to stick around forever and ever. All right. So unless you put that 10% down, then after I think it's 11 years or so, then it winds up going away. But you want to make sure, and most people that are taking FHA loans aren't putting 10% down. So you want to make sure that we have some sort of plan for the future to get out of this thing, because we don't want to be stuck in an FHA loan playing that MI forever and ever. So again, these loans they're insured. VA loans, similar situation. We'll get into them in a minute. They are guaranteed. All right. So the big difference between appraisals with government loans, and by government loans, I mean FHA and VA loans, is that there has to be health and safety issues that they review that are above and beyond what conventional loans are. Although I have seen some conventional appraisals have the same call outs as these, but you have to have, you got to have some sort of way of cooking your meals, and no, a plug-in microwave does not count. You have to have a stove in there. You can't have like man-fed heat like some of these shacks up in like Julian or Idlewild or whatever. They've got like these big stoves that you just feed the wood into, and then you have heat. Those, they don't count. You can't get this type of loan there. Same with the USDA loan too. Those are 100% financing, by the way. And we do have a lot of USDA areas here in San Diego. Sorry, another tangent. But any kind of rural areas, the USDA has 100% financing loans, very comparable to FHA loans. And they're great if someone's looking like in the Fallbrook, so parts of Temecula, out in Julian, you can wind up getting one of those types of loans for 100% financing. It's pretty cool. But you do have to have, complete rooms. Like they can't be exposed wiring. Like you can't have like floorboards exposed and stuff like that. You have to have a floor in place. So make sure that if you walk into what you think might be a beater or something that can use some TLC, that you wind up checking with us, take some pictures and send it to us, and we'll have our appraisers review them and make sure that you could do that loan there. All right.
Hey Eddie,
Yeah.
this weekend I was hosting an open house at a condo that recently had its flooring. You want me to turn my video on?
Hmm.
Oh, whatever. Recently had the flooring redone, and someone came in, and I forget what her job was, but I think she said like HVAC. She asked about the CCNRs and if there were rug pads under the rugs or if it was needed because the flooring was redone, and I
Yep.
kind of didn't really know what she was talking about.
Yeah, so even if you put in hardwood floors, I had to do this in my condo. There has to be some sort of sound barrier between you and the floor below you, right? And it's typically they put it on second story and above because if you're walking around and it's like if you wind up putting wood on wood and people are walking around on top of it, it's like someone's walking around on your head. So there are mandatory requirements, and I don't know exactly how thick it is. But you have to have a layer down of sound protection, and then the floor goes on top of that. So with
Okay, so
carpeting,
this isn't like you need to move in and throw down a bunch of rugs. This is like she was just asking if the
no, it
flooring
had to
was
be
properly
done.
redone.
It had to be done properly when it was installed. Yeah, and
Okay,
that
okay, yeah,
should
yeah.
have been reviewed by the installers up front if they were legit.
Okay. And then I had another buyer have a couple of HOA questions,
Yeah,
which I asked the seller and the seller's agent who haven't gotten back to me yet. Is that like a just wait? Should I call the HOA, ask them myself? It was like, when was the roof last redone? How much they have in reserves? When's the next assessment? How often are the assessments?
right. So those are all qualifying questions that banks ask for a loan. So that's why they're probably asking about that. It's probably they've had an issue already.
No,
Um,
they told me they did. I'm just curious, do I reach out to the HOA or should I wait for the seller's agent or the seller to get back to me?
I'd wait.
Because I've asked, but they haven't gotten back to
So
me.
this is your buyer?
I was hosting an open house um for Sal,
Hmm.
and the buyer just mentioned they had a bunch of issues with all the condo, no HOA reserves going on. They've gotten burned. So they're just,
Right.
they walked in, they had all the questions ready, and I'm like looking at them
Right.
like, you guys sound like you know what you're looking for. And then I just haven't been
Just
able to get the answers
get
for
back
them.
to them. If you have all those questions, I would look it up on Redfin. They usually down the bottom of Redfin, it'll say who the management company is and call them and ask them.
Okay,
That's
perfect.
the
Yeah,
easiest
yeah.
way.
Thank you.
Yeah, no problem. I mean, we can help you as well, but that's really kind of an easy one that you can just
Yeah,
call
I'll give
them,
him a call.
get the
Yeah,
answers
yeah.
yourself. Yeah, for sure.
Perfect.
Um,
Thank you.
Yeah, absolutely. Or you can also tell them that you've got a great lender that will get all these questions answered for you in advance. If you'd like to, I can connect you for them. Put us on a text message.
Hmm.
And I'll call them and make sure that we get these questions answered for them too.
Yeah,
Because they
perfect.
might
Okay.
have deeper questions, financing questions, because these are financing questions that they might have,
Hmm.
that I might be able to answer right on the spot.
Cool.
All right. But great question. No flips allowed, you guys, if you're going to be buying an FHA loan, no flips within the past 90 days. So if you walk into a house and you have an FHA client on your hands and they are looking at it and you're looking at a brand new, like completely renovated home, you got to go back and pull the title profile and see when that home was last purchased because that can't be a flip. If it was purchased in the last 90 days, you won't be able to do an FHA loan now. Okay. It's the only type of loan that I've seen. There's a couple of jumbo loans actually that have the same rule, but it's the only like traditional loan out there that has that requirement. Conventional and VA, they don't care, but FHA, there's no flips, 90 days. Um, and then with condos, you guys, there's a website. It's right here, and I'll share it with you guys. That has condos that we need to be able to show that they are FHA approved. And I want to make sure that you guys are aware that where this is and what it looks like. So really quick, we're going to just take a tangent again, and I'm going to show you this is what the website looks like to find a condo FHA approved. Now, mind you, I typically put in a zip code, right? And the reason being is because I've seen knuckleheads misspell condo names. Seaside, I've seen Seaside misspelled. I've seen Chula Vista misspelled, Escondido misspelled. So all of a sudden, you go and put in the name of the city, or you go put in the condo name, and it's not there. You're like, what is going on? 5 numbers is really hard to misspell. So I typically put in the zip code and then just click send, 92111, send, and then it's going to pull up every single condo complex that's approved there. Now, here's the thing, you guys. Back in, I forgot when exactly it was, but we had back in 2011, I believe it was, yeah, 5/30/2011. FHA decided to expire every single condo complex in the country and make everybody get reapproved. Isn't that awesome? So you'll have a lot of ones that say approved, expired. You just need to get in touch with us because we might be able to get it reapproved. We need to get some documents. We'll order the documents. We'll pay for the documents, and we'll get that approved up front for your seller. And that's huge. Think about the pool of buyers that you're adding by getting it FHA approved, right? But this is how you go and find your condo complexes. And again, they will say rejected, and sometimes it'll give you notes, right? And it will tell you why it was rejected. And it'll say on here, this is a PUD. It's not required. Hope you guys remember what your PUDs mean. Does anybody remember what a PUD means? No? Planned urban development. So if you have a PUD, it's not a condo. It's a house. You can still have an HOA. I have an HOA. I live in a house. But it's in the PUD. All right. So you want to make sure that you're looking at condos and not PUDs. And usually, just a real quick shortcut, the APN ends in a 00 on these PUDs. All right. So that's how you look up your FHA approved condo. But just reach out to us. Matt and I will look it up for you. Not a problem. There's also some cool renovation loans for FHA and VA that you can do. FHA will allow you to go like up to $50,000 for a loan that you can tack onto fixing up that house. It's pretty cool. So it will delay the kind of the approval process a little bit, not the loan itself. Like we'll ask for 30 days, sometimes even 45 days, depending on like the house and how ready people are. But you can have a client go out there and find a house for $500,000 and tack on an extra 50 grand of repairs onto the loan up front and finance it all. And the thing is that they need a HUD specialist to go out there to get the plans, to get the scope of work, to provide those documents over to you so that we can order the appraisal and provide them with all these specs. And then they're going to appraise the property as if that was already completed, which will give you a different appraised value than as is, right? Which is the way that appraisals usually are completed. So let us know, and we can work with that as well. It's a really great option if someone wants to get some work done. FHA loans, a little bit more in depth. But they're not that scary, you guys. And they're there for the right people, not for everybody. Any more questions about FHA loans? Kind of running up on the hour, so I'm gonna try to fly through the VAs. There's a couple of things that I really want to make sure that we cover. If we don't have any questions, VA loans, you guys, just like FHA loans, 580 is your score. They're the easiest loans that we handle. I don't know why people are scared of them, but they're the easiest loans ever. People get paid once a month. Their income, you can gross it up by 25% because half of their income, their BAH and their BAS, is not taxable. So we can gross that income up and qualify them for a higher loan amount. It's got to be owner occupied. These are also it has to, you can have more than one at a time. Like I have a veteran right now that's buying his second home with a VA. He does need to come up with a down payment. There's a really convoluted mathematical equation to figure out how much eligibility is left, right, for a veteran. However, you do have the ability of using it twice, right? He lived in Virginia. He was stationed in Virginia. He got stationed in San Diego. Now he's coming out here. He's up in Pendleton, and he's going to be buying another VA loan. He needs to put down $46,202 to buy an $850,000 home. Not bad. The rates are less expensive because it's guaranteed. Same with an FHA loan. They're less expensive than a conventional loan because it's insured. Right. So these rates, when we compare and contrast, when they're putting that much money down, we do make the comparison because there is no mortgage insurance on a VA loan. There is on a conventional, if you don't put 20% down, and there's always on an FHA loan, but there's not on a VA loan. But you do have that upfront mortgage insurance as well. We're going to cover that in a second. You can have co-borrowers on your loan. They don't have to be veterans. But if they're not a veteran, then you have to put 12.5% down because the VA guarantees 25% of that loan. Okay. So if there's a non-veteran, they have to pay for their 12.5%. Okay. As a down payment. And then the rest of it. So, but I've never really seen that work out. I've never really seen it make sense to go VA. If you're putting that much money down, we usually do the compare and contrast with a conventional loan, and usually it makes more sense to go conventional because again, unless your all of your funding fee is waived because you have some sort of disability, they're tacking on you guys when you first buy that house. They're tacking on 2.15%. Just like FHA was 1.75, with the VA, if you're doing less than 5% down, 2.15. And if you're putting 5% down, 1.5, and 10%, 1.25. And then if you use it a second time, it's 3.3%, which is huge. That's a lot of money. Think about it. You buy an $800,000 property and you're tacking on like $27,000. That's a lot of money to tack onto the loan amount. So their break-even point is going to be that much longer, right? Because it's going to take them a while to pay down that extra money that's getting tacked onto the loan. So keep in mind. Let's see here. Short sales, they don't care about short sales. You can literally short sale your house and go buy another one the next day. Well, your credit's probably going to be shot, so I don't know if you're going to qualify from that perspective, but you can. And then BK and foreclosures are also a lot less. All right. Only 1 year out for Chapter 13, 2 years out for Chapter 7. And like I mentioned, there is no funding fee. There's no mortgage insurance, just a funding fee. All right. Again, coming back to this 3.3, you guys, if they're using it a second time, and otherwise, if they're putting money down, 1.5 and 1.25. There are some, you can do a cash out refi up to 90% with a VA loan. And you can also, you also have some funding fees on there. If you're going to be taking over like an interest rate reduction loan, easiest thing in the world. After 6 payments, we can reduce the veterans loan for them, their interest rate, no income, no appraisal, no anything needed. We just reduce the loan amount, have to reprocess the application, and done and done. Just going to make sure that they're making their payments on time. Just like the FHA, the house has to be in good condition. Okay. So again, no broken windows, no like exposed wiring, stuff like that. A fence leaning, I've seen that be called out before. I've seen calcium buildup around an outdoor spigot, right? A water spigot. And that was called out because they thought that there might be a leak underneath the foundation somewhere. So that got called out to have additional inspections done. Wobbly railing, walking up into the house, a couple of steps, that thing's wobbling. It's a health and safety issue. Termites can cause health and safety issues. So with VA loans, there has to be a Section 1 termite clearance. Section 2 is not necessary. Anyone can pay for it. Okay. Your neighbor can pay for it. Your plumber can pay for it. Your mother's best friend can pay for it. Like, it doesn't matter. Anybody can pay for it, right? I don't know why anybody else would pay for it except for the seller, because it's still their home. The buyer does not want to pay for somebody else's termite clearance, because think about it. What if that loan at the last second doesn't go through? Now you just paid to fix somebody's house for them. So yeah, no, thank you. It has to be completed prior to close of escrow, but we can push the clearance back prior to funding, right? So right in the last second, as long as we get that termite clearance, we're good to go. We can fund that loan. If your condo unit is up on the second floor or above, they're not as worried with termites. But if it's on the ground floor, they're definitely going to call it out. They're going to want to see it. And if a condo unit, also I've seen if condo unit owns a parking spot, like a parking garage, that garage needs to be inspected as well. I've seen that hold up a loan as well. So keep that in mind too. If somebody was to get a termite inspection, which is a good idea, in San Diego, we're on a very high risk for termites because it's so dry here year round. And pretty much every house has termites. But if you have a listing, one of the first things I would recommend is going and get that termite inspection done in advance. Those reports are usually free. Sometimes they cost as much as like $75, I think. But look at the end of the day, at least you'll know the issues that you're going to be facing during escrow in advance. So get that inspection done up front and order it right away when you get into escrow. Okay. Because the last thing you need is, oh, it's a VA loan. Totally forgot we needed, termite clearance. And then like in the 11th hour, you're ordering some termite inspection company to go out there and inspect the property. And oh, guess what? We got to tent the house. That's going to take, 2, 3, 4 days, 5 days to get out there, whatever. So just make sure you're proactive on termites in San Diego. All right. And then the big thing that I want you guys to know is VA non-allowables, y'all. So if you have a bank out there, and there are plenty of banks, Navy Fed being the one of the major ones out there that advertises a 1% origination fee, right? With those crazy interest rates that they advertise that nobody ever gets, right? If you wind up charging a veteran a 1% origination fee, you can't charge any of these other expenses. Zero. No. Can't. That 1% is meant to cover all this. So you guys be careful of those origination fees. You want to make sure, and I've seen banks charge not only 1% origination fees, but I've seen banks like tack on 4 points and offer like, get a 4.75 interest rate. Yeah, well, you know what? You're paying 4% of that loan to buy it down to 4.75. But borrowers don't understand. And all they see is that one interest rate number. They don't realize they're getting charged tens of thousands of dollars to get that rate, right? So it's really important to have them working with someone that you trust that's looking out for their best interest and yours, that they don't get bit in the ass, because it's a possibility. There's a lot of unscrupulous loan officers, unfortunately, out there that still do a lot of business, and they swindle money left and right. It happens all the time. It's sad to see. But that is VA, kind of the nuances behind it. If you have anybody that's a veteran here in San Diego, we love helping our veterans. Please let us know whatever we can do to help them out. And again, condos, they have to be VA approved. And like we mentioned earlier, Matt's been kicking ass at getting them approved within a couple of weeks, right during escrow. That's it, you guys. Right at 10 o'clock. Perfect timing, 1 hour. Questions, y'all? Anybody? I know I went through a lot of stuff today. You can always go back and watch it. I'm going to put it on YouTube.
Oh, that was actually going to be my question. You mentioned you're recording it, and I was going to ask, where can we watch it?
Yep.
YouTube.
Just put my name into YouTube, and
Easy.
all my past classes for the past couple of years are on there. So if you want to check out something else, down payment assistance classes and stuff like that, it's all on there. Condo classes and non-QM loans, all sorts of stuff that we've been teaching, 1031 exchanges. I got to post a new one today with the reverse mortgages. I think I haven't posted that one yet. So yeah, if anybody has any questions, YouTube, it's on there. Or just call me. You guys have my phone number. I'm always in the office. You can always find me. Cool. Thank you guys so much. Really appreciate you spending your Monday morning with me. I'll see you guys soon.
Have a great week.
All right, bye, guys.
See you guys.